Hello everyone. Today I'm going to talk about an important topic in accounting, that is deferred revenue expenditure. Basically, the expenditure has been divided into three parts: capital expenditure, revenue expenditure, which we know commonly, and one more category of expenditure is known as deferred revenue expenditure. Before I go for deferred revenue expenditure, just I would like to give brief introduction about capital expenditure. The capital expenditure leads to the purchase of fixed assets, which increases the earning capacity of the business. Basically, the organization derives benefit from such expenditure like capital expenditure for long-term purpose. The basic examples of capital expenditure is purchase of building, purchase of plant and machinery, purchase of furniture, all these. Whereas on the other hand, revenue expenditure is that form which organization derives only for period of 1 year. Basically, this helps in running the business. This is for just one accounting period. For example, cost of raw material, labor expenses, depreciation on assets, all these things will be coming under the revenue expenditure. The one more category of expenses, basically this is referred as deferred revenue expenditure. What exactly it means? These expenses are revenue in nature, the incurred in 1 year, but that will be useful for subsequent years. It could be 3 to 5 years, 5 to 7 years, like that. So, what are the main features of the deferred revenue expenditure? This is revenue in nature, so that is why it is called as a deferred revenue expenditure. We are incurring for one accounting period, but the benefit of that expenditure lasts for almost 3 to 5 years. It pertains, only or partly for the future years. As it is a huge amount of expenditure, basically this will be the lost for number of years. They don't fall under the capital expenditure because these are the heavy expenses but don't result the acquisition of an asset. The different revenue expenditure is not an acquisition of asset. This benefits from these expenses for period more than 1 year. It is a crucial expenditure, so we need to show it in the income statement like trading and profit and loss account and balance sheet for transparency purpose. It is also have one more thing. It is basically depend on the matching principle. How much expenditure we are incurred to generate revenue? That should be basically for one accounting year. So the expenditure which is incurred for 1 year, how much revenue is generated for that year, that should be matching principle. The deferred revenue expenditure is basically on the basis of the matching principle. So again, I'm going to tell you the deferred revenue expenditure which is incurred in one accounting period that will be useful for subsequent years. One more thing I would like to tell you that the expenditure instead of being recognized and expect all at once, this expenditure gradually expensed over a period of time. So we need to show it in the profit and loss account and balance sheet for transparency purpose. So I'm going to discuss how it will be. See, there are different types of. Before I go for the accounting treatment, I would like to tell you some of the examples of deferred revenue expenditure. First, prepaid expenses. Basically, the main example of deferred revenue expenditure, the prominent example is advertisements. So, promotional expenses, promotional activities. The expenditure, see what we need to do here, the expenditure is born in 1 year, but that will be written off for several years, several periods. So, that is a prepaid expenses. Second example is exceptional losses. The example is discount on issue of debentures, the cost of research and development expenditure, because these are the exceptional losses. For example, an earthquake, floods, or unforeseen losses by any loss or any confiscation of the property, all these will be coming under the deferred revenue expenditure. These are the exceptional losses. The one more thing is services rendered. So here the research and development expenses we are incurred for that. we providing services. The services, it cannot be allocated for 1 year, because we whatever we provided in research and development, that will be used for many years. So there will be no asset created with such expenditure, so this will be coming under the deferred revenue expenditure. One more example is fixed assets, like preliminary expenses. All these will be coming under the deferred revenue expenditure. So then I will go for the accounting treatment. The basically the deferred revenue expenditure is not meant for I mean the expenditure incurred 1 year, but it is not meant for 1 year, it is for several years. So what we need to do, how we have to show it in the profit and loss account, how we have to show it in the balance sheet. So we have to spread over the number of years. So what we have to do is some part of such expenditure we need to show it in the profit and loss account debit side. Remaining portion of the expenditure, the rest of the remaining expenditure, we need to show it on the asset side of the balance sheet. So for example, I will show you here clear cut example I have given here. If any firm has expenditure for 2 lakhs rupees for advertisements, for introducing new product or promotional expenses, whatever it may be. So basically, we are estimating. We have to estimate. That depends on the firm to firm, industry to industry, and accounting standards to accounting standards and different countries. So the estimation has to be done by the firm itself. So, for example, the estimates that benefit will last for 4 years. In such case, out of 2 lakhs, 50,000 will be charged to the profit and loss account. The remaining balance, show it to the balance sheet under the asset side. So the journal entry will be like this: profit and loss account that are to advertisement account 50,000. So the what will be done? The 50,000 we need to show it in the debit side of the profit and loss account, and 1,50,000 we need to show it in the asset side of the balance sheet as a deferred revenue expenditure. See, this will be the journal entry, and trading and profit and loss account will be like this, and the balance sheet will be like this. So the before I go for another thing, just I would like to tell you what are the differences between deferred revenue expenditure, capital expenditure. See, deferred revenue expenditure is also for several years. Capital expenditure is also for several years. So, but deferred revenue expenditure normally it is for 3 to 5 years. But whereas capital expenditure, it is meant for 10 to 15 years. It is benefits for long time. The capital expenditure is long time. On the other hand, deferred revenue expenditure for 3 to 5 years. Right. Second difference is that capital expenditure can be converted into cash at any time, because it is investment in the fixed assets. We can sell it off, or we can get the investment return out of it. We can convert into the cash. But whereas deferred revenue expenditure, we can never convert into the cash, because we have already incurred. We can't get it back. What we have to do is we have to write it off in the balance sheet. So in the profit and loss account, we have to show some amount, and rest of the balance we need to show it in the asset side of the uh, balance sheet. So writing off, it can be so capital expenditure can never be write off. We can show it as, see, whatever the depreciation will be there, we have to show it as a depreciation, and we need to show it in the debit side of the profit and loss account. Whereas deferred revenue expenditure, we need to write it off for 3 to 5 years. So the the conclusion means the deferred revenue expenditure is different from different accounting standards will follow in different countries. Indian gap is there, US gap is there, IFRS is there. So depend on that, they are going to follow the treatment, accounting treatment on deferred revenue expenditure accordingly. Right. So additionally, this expenditure, the business practices, industry norms, company to this differ from company to company, firm to firm, and the business practices and industry norms, what they are following. So before going for the accounting treatment of this, we need to consult the financial professionals or accountants, so for proper accounting treatment for this contest. This is what in nutshell about the total deferred revenue expenditure. Thank you for watching this video.